Δυστυχώς δεν θα μπορέσω να μιλήσω στα ελληνικά. Τα ελληνικά μου είναι ελληνικά 10χρονου και and so I'm going to speak in English. If anybody has any questions or doesn't understand, I will try and deal with that. On top of that difference, my talk is also a little bit more technical. It is non-mathematical. It has no symbols or mathematics in it, but it is nevertheless technical. So I will talk about the results of a research team that we have at Imperial College in London. It is a technological university in England, which includes about 40, 45 PhD research projects. We don't do anything else, it's only research. But it's all funded by banks from the City of London and from some large corporates. So this is the background to this kind of work. It is axiomatic that the purpose of enhancement of wealth management, is to maximize some return over some period of time. The period of time depends on the investor. The risks that are going to be taken depends on the investor. And given those constraints, to maximize the wealth at the end of this horizon without taking any unnecessary risks from now until the end. So it is, oops, let me just, I will need this. Okay, there must be some technique for using this, that's it. So I'm going to talk about the process, the general process, first of all, of wealth management. I have 15 minutes and I have 15 slides. So I'm going to be going one slide per minute. The process starts from some component that is market-driven, has nothing to do with any investor, has to do with the market. Normally, you have some data that comes externally. Not normally, always, you are going to have some data that comes externally. Some of this is market data, and some of it is economic data, which are a lot less valuable than the market data. It's less reliable. Nobody pays to get that data. That's mostly statistical, whereas that is a lot more reliable data. You may or may not want to take the reliability of data that you are getting into account. In order to make a scientific procedure for managing wealth, you need to have some model. This is a quantitative model. It can be mathematical or it can be not. But in any case, it has to be analytical. It has to be a rational model. My experience is only in mathematical kind of models. And this is a model of how returns are produced. You need to have some forecasting. In the absence of any forecasting, you're only going to look at history and nothing else. And there are problems with just looking at history, as I'm going to point out later on. During the panel discussion, in fact, I will be concentrating on the question of risk and how it can be underestimated if you just look at history. The second part of the wealth management process has to do with the investor. He has to set some components. This could be a specific product done for this investor, or it could be explaining to the investor, if he's going to invest in a hedge fund, for example, what are the risks and returns that are expected from this hedge fund and what he should expect. So there is a risk appetite, and the fund manager has to set some objectives depending on what the investor wants. And then there is a model which chooses the best portfolio to have in order to maximize the return of this fund subject to the risk control that is required by the investor. There's a lot of information here. I'm going to just skim through most of it. There are also acronyms here that you will not be able to recognize, but essentially, let me just concentrate on the left-hand side. The economic and market data you have very often have missing information. And it's part of the pre-processing of that data is to predict what the missing information is. This information is due to asymmetries on an international level of holidays, of the time of closing of different markets, and so on. The asset return model is one of the problems that have produced the credit crunch that we have been through. In fact, it is the main one, because one of the traditional ways of looking at modeling what can happen to assets, this can be equities, it can be bonds, it can be credit derivatives, whatever the asset is, even more so if the assets are illiquid, like real estate and things like that. The problem with the modeling of what can happen to those asset prices can lead to huge problems in the construction and the risk of the portfolio. The regime switching models have become popular now. They should have been popular before. They are to say that we don't have one market. History is not one history. It is broken up into different periods where sometimes the financial system is stressed or distressed, and sometimes it's under normal conditions. And by just looking at some average of these, just looking at history and considering it as a template of what may happen in the future is extremely misleading, because averaging a normal situation with a bad situation gives you almost a normal situation, because the bad situations don't stretch for as long in history as, on the other hand, many companies go bankrupt during those situations, and they don't appear again in the statistics. If you look at these historical statistics, it's all biased because the companies like Enron are not there anymore. So, how asset returns are modeled is important. I'm going to skip most of this stuff and say that any optimization that you do in terms of picking a good portfolio has to be robust. There's one flaw in optimization and one flaw in trying to pick the best that can be done, and that is best always goes with sensitive. The best solution is also a very sensitive solution. If any of the assumptions you have made are not correct, that solution is going to change a lot. The results are going to change a lot. So you need to include some consideration of robustness in order to make sure that if what you have predicted or if what you have assumed is a model of asset returns and so on happens to be incorrect or slightly at fault, then you don't have results that are very, very greatly affected. Let me skip that and go to a diagram that explains what the situation is. Suppose that the financial system is in two states. a distressed state, a normal state, and a distressed state. If the system is in a normal state, there's a 95% chance that next week or next day or next month or whatever is your period of time, it will remain in the normal state. There's a very high chance, and there's a very low chance, 5%, that it may go into a distressed state. If you're in the distressed state, again, there is a high chance, 85%, that it will continue to be distressed, and there is a 15% chance that it will change and become normal. This is the simplest possible model that you can think of. But it's easy to understand that once you go into a state, you're going to continue being there for some time before you get out of it. With the numbers I gave here, I'm not saying that these numbers are real or typical. I'm only just putting them there for an example. With the numbers that I put here, 3/4 of the time you are going to be in a normal state, and 1/4 of the time you are going to be in this state. That's the result of those numbers I put here. So what does this model produce that the normal models that are used for pricing options, pricing credit derivatives, all the complicated products that mortgage-backed securities and so on that have produced all these problems that we're having over the last year and a half, what does this model produce that does not exist there? What it produces are what are called fat tails. There is a strange expression. It means that events that you thought are very rare, that can happen once every 50 years, or we heard some absurd numbers, happen every couple of years. And you say, what on earth is going on here? The probability of this thing happening is 1 in a million. Why has it happened 2 years ago and it's happening again now? So there's clearly something needs to be done to say that rare events are not so rare as you might have thought. It also includes this volatility clustering, which is what I was saying, that once you get into a state, you tend to remain into that state. So once you go into a distressed state of high volatility, then you're going to stay there for some time. This is just, spend a little bit of time on this. Taking an example, take the S&P 500. Suppose it starts from a normal state. It can either change instantaneously to a distressed state and then continue from, this is time 1, this is time 2, this is time 3, and so on. Time is along that axis. And the circles here, the vertices here, represent states of the world. I have chosen a very, very simple state of the world. It is described only by the S&P 500. In reality, you will have a multidimensional, many things describe the state of the world, maybe 20, 30 parameters. I don't have here anything about interest rates, inflation, exchange rates, and so on. So from this state, you can have 4 possible states, some of them with the S&P 500 going up, there, and there, for example, and then some are going down. And from each one of those, some of them going up from here, and some are going down, and the same. And you can see that I can propagate that through time and have a model of what can happen to the S&P 500 over the next period of time. If the time slot, for example, is a week, if I have 52 of these, it is what may happen in the next year. It is the numbers at the end are going to be huge. If you do this and you look at what has happened to the risk that is inherent in this kind of model of having different states of the world and switching from normal to distressed states, and you compare it with the more traditional techniques, you find that the risk involved in this is very, very much greater than what you would get under normal circumstances. In fact, in just 2 weeks, if you take the periods to be 2 weeks, the risk computed from here in just a 2-week period is doubled. It's double of what the risk is with what is normally used for option pricing and so on, all the other methodologies and computing, and the risks that the banks use for computing value at risk as the requirements for reporting bank risk and so on. Much of the computation of risk using value at risk and use is some normal distributions for the outcomes are grossly underestimating the risk. Very few things I'm going to say here. Not really enough time to go through in some detail, but forecasting is something that has improved enormously recently. Recently meaning in the last 2 years. Nobody is going to be able to forecast what the future is. That's not the issue. Forecast is not to say that the S&P 500 is going to go up by 20 points tomorrow. That's stupid. Nobody is that good. By forecasting, I mean a shift in the distribution that you would deduce by looking at the past, a temporary shift in that distribution to represent what may happen in the next period. So again, in the what may happen tomorrow or in a week from now and so on, is described by a number of different possibilities. These possibilities are slightly different from what would be deduced from historical distributions. They are shifted either up or down slightly. So you cannot make a definite decision, not even a moderated definite decision as to what may happen tomorrow. For example, if you are correct 52% of the time and 48% of the time you are incorrect in your forecast, this would be a great thing. This is the kind of values that we're talking about. Small, but extremely significant, because if you are running a hedge fund and you are going to be a long-short hedge fund, let's say, with 40 assets long and 40 assets short, market neutral, sector neutral, and so on, then having 80 assets, each asset being just 52% probability of being correct, the portfolio is going to be 90% correct. This is the law of large numbers. It's a statistical artifact. It has nothing to do with being good or anything else. Equally important is that if you're going to use some sophisticated methodology for choosing a portfolio, and you're using some forecasting as part of this process, you have to consider in your portfolio selection algorithms, let's say, you have to consider the possibility of limiting the risk that all your forecasts are wrong. Obviously, the forecast can be correct or it can be wrong. You cannot have a catastrophe if you have forecasted something wrong. So the uncertainty in the forecasts is taken as seriously as the uncertainty that is induced by the market movement of prices. This is something that is, again, recent. In the past, there was a forecast, and you acted on the forecast. You didn't consider the consequences of that this forecast is uncertain, and you want the solution to be insensitive to your ability to forecast well. I'll go to the next one. The optimization models use some mathematical techniques with the names like dynamic programming, mixed integer programming, and so on. I'm not going to even attempt to describe that. but I have them on the slide just in case somebody has had any background in this. Will identify what these models are like. The important thing is this here I have in red, which is the robustness of the solution. You want an optimal solution, but which is robust to changes in the market and to errors that you have made yourself, and indeed to errors in the input data, of which there are many. Here is an example of something that perhaps could not be achieved a couple of years ago. This is just an example from a fund that we help the technology with. This is a fund invested entirely in the stocks 600. This is erroneously called Euro stocks here. So this equity only. Of the 600, the 380 most liquid are considered, and we want it to be sector neutral. So in every sector, there was equal amount of money, long and short. Currency neutral, so it considers the various currencies in Europe, and has some restrictions on it, which are imposed by the fund, that some confidence that the monthly loss is going to be less than something, and the quarterly loss is going to be less than something. And one can get, under the normal fund structure of 2% management fee and 20% of the performance fee going to the fund, you can achieve return to investors. This is a 19-year back test, and I have taken the results of the last period, which was the period that includes the distressed regime, in order to show that this was not something that affected the results a great deal for this. In fact, if you look at the performance results, you will find that you cannot identify when the stress was. And that's about it. So that was the conclusions, that it is a summary of what I have said. And I'll be happy to take any questions either now or during the panel discussion.